California's housing market is doing something it's never done before. While some cities see home prices climbing toward record highs, others are watching values actually drop. The same state, the same year, completely opposite directions. A home in San Francisco now costs an extra $915 per month in mortgage payments compared to just 3 years ago, even if you buy the exact same house. Meanwhile, in parts of inland California, prices are finally starting to decline. And across the country, the Sun Belt cities that promised affordable alternatives are running into their own housing crisis. This isn't just about California anymore. It's about how America's housing market is splitting into two completely different realities. Let's break down what's happening. For decades, California's housing market moved as one. When prices went up, they went up everywhere. When they cooled, the entire state felt it. But 2025 has revealed something different. California's housing market is fragmenting. The median home price across California sits at just under $900,000. But that number hides a widening gap between coastal cities, where prices keep climbing, and inland areas where the market is finally cracking. This divergence tells us something important about where American housing is headed. This smot. It's about interest rate lock-ins that keep people trapped in homes. They might want to leave. It's about property tax laws from the 1970s that make moving financially painful. It's about climate change adding thousands to your annual costs. And it's about what middle class even means anymore, when the average home looks completely different depending on your income bracket. Let's explore why California's housing market is no longer moving together and what that means for the rest of the country. The frozen market, when nobody can move, California's housing market has essentially frozen. New home listings in San Francisco fell by more than 17% compared to last year. San Diego, Riverside, and Anaheim all saw double-digit declines. Of the 10 metros nationwide where new listings dropped fastest, 5 are in California. Real estate agents across the state report the same thing. Transaction volume has absolutely slowed down. A combination of high interest rates and what economists call affordability, which is just really, really low. But California's freeze runs deeper than the national trend. The lock-in effect during the COVID-19 pandemic, the Federal Reserve dropped interest rates to near zero to jumpstart the economy. Homeowners rushed to buy or refinance at rates below 3%. Then, facing rising inflation, the Fed reversed course and jacked rates back up. The Fed reversed course and jacked rates back up. Today's new mortgage comes with a rate above 6.5%. For the average American homeowner, swapping their existing low-rate mortgage for a new one would cost an extra $398 per month. That's a compelling reason to stay put. But California homeowners face an even steeper penalty. Because property values here are so high, nearly $900,000 for a median single-family home, even small interest rate changes add up fast. A typical California borrower would pay an extra $675 every month if they took on the same mortgage at current rates. In San Francisco, that jumps to $915 per month. That's an extra $11,000 per year just because you moved. The Proposition 13 problem California homeowners have another reason to hunker down. Proposition 13. Since 1979, this law has tied property taxes to the purchase price of a home, with only modest annual guises allowed. The longer you own your home, the less you pay in property taxes compared to someone buying the same home today. A recent analysis found that new buyers in Los Angeles, San Diego, Long Beach, Oakland, and Sacramento can expect to pay more than twice as much in property taxes as long-time homeowners. When you're calculating whether to move, that tax difference, stacked on top of the higher mortgage payment, makes the math brutal. As one economist put it, when people are doing the math about how much money it would cost them to move, and they look at the mortgage expense, and then, on top of that, the property tax expense, it's not worth it. This creates a vicious cycle. Fewer listings mean less inventory. Less inventory means higher prices for whatever does hit the market. Higher prices mean fewer people can afford to buy. And the cycle continues. The diverging markets, coastal versus inland California. While California's overall market has slowed, different regions are moving in opposite directions. Coastal cities, San Francisco, San Jose, Los Angeles, San Diego, continue seeing upward price pressure. These areas attract high-earning professionals in tech, finance, and entertainment. Remote work has actually increased demand in some coastal neighborhoods as people seek space while maintaining access to cultural amenities and good weather. But inland California tells a different story. Cities in the Central Valley and further from the coast are starting to see price declines. These areas boomed during the pandemic as people fled expensive coastal markets. Now, as remote work mandates ease and people return to offices, some of that demand is evaporating. The result: California no longer has one housing market. It has several, moving at different speeds and sometimes in different directions. The national picture, this divergence, isn't unique to California. Across the country, according to recent forecasts, 10 major U.S. cities may see home prices fall in 2026. These include markets that were pandemic darlings, places where prices shot up when people fled expensive cities, but where fundamentals don't support continued growth. The cities most likely to see price drops share certain characteristics: rapid pandemic-era appreciation, exposure to climate risks, or local economies heavily dependent on industries. Meanwhile, housing markets with strong job growth, limited new construction, and population inflows continue seeing price increases. The national housing market is increasingly a fiction. Local conditions matter more than ever. What defines middle class now that divergence shows up in another way? What middle class means has completely fractured. A recent viral TikTok trend had people sharing average middle-class home tours. The result was jarring. Some showed modest three-bedroom houses. Others featured sprawling properties with home theaters and multiple living spaces. Both families considered themselves middle class. This reflects what economists call the K-shaped economy, where outcomes for different income groups are diverging sharply. Upper middle class households have seen wealth grow through rising home values and stock portfolios. Lower middle class households struggle with stagnant wages and rising costs. A household earning $100,000, well above the national median, still struggles to afford an $800,000 home. The down payment alone would be $160,000. Monthly payments, including taxes and insurance, could exceed $5,000. That same income goes much further in most other states. The Sun Belt Trap, the affordable alternative. For years, the narrative was simple. California's too expensive. So people are moving to affordable Sunbelt cities like Austin, Phoenix, Las Vegas, and Boise. Lower costs, more space, growing job markets. More space, growing job market. But a new problem has emerged. The Sunbelt is running out of housing too. Cities that promised affordability are now facing their own housing shortages. Rapid population growth has outpaced construction. Of zoning restrictions that weren't an issue when these were smaller cities now constrain supply in the most desirable neighborhoods. As one analysis put it, even Sunbelt cities are encountering housing shortages because they're not building enough in the places people actually want to live. Phoenix saw some of the fastest home price appreciation in the country. Austin, once affordable, now has a median home price approaching California's secondary markets. Las Vegas faces similar pressure. The climate cost factor. There's another challenge emerging in many Sunbelt destinations. Climate change is making them more expensive to live in. California is experiencing this. Climate-related costs are accelerating the state's cost of living crisis in ways that don't show up in home prices or rent figures. Rising insurance premiums for fire-prone areas add thousands per year to homeownership costs. Some areas are becoming effectively uninsurable. Water costs are rising as drought conditions persist. Energy bills spike as extreme heat requires constant air conditioning. A report noted that the poor are in a very bad state as climate change compounds existing affordability challenges. Lower-income households spend a larger share of their income on utilities and have less flexibility to absorb sudden insurance increases or repair costs from climate-related damage. Sunbelt cities face similar climate pressures. Phoenix deals with extreme heat that pushes cooling costs higher. Florida faces hurricane risk and flood insurance that can cost more than the mortgage itself. Texas faces both extreme heat and power grid instability. The affordable alternative isn't staying affordable when you factor in climate adaptation costs. What's next for 2026? The market forecast, despite all these challenges. California's housing market ended 2025 on firmer, more stable ground, according to some analysts. This doesn't mean affordable. It means predictable. Home sales have stabilized at lower levels. Prices have plateaued in many markets rather than continuing their meteoric rise. New construction remains limited, but the panic buying has subsided. For 2026, forecasters expect continued divergence. Some California markets may see modest price increases of 2–3%. Others may see flat or slightly declining prices. The days of uniform 10–15% annual appreciation across the entire state appear to be over. Nationally, the forecast is for a tale of two markets. Cities where prices grew modestly during the pandemic and have strong economic fundamentals should see stable or slightly rising prices. Cities that saw explosive growth during 22 may face corrections, as that growth proves unsustainable. The cities to watch 10 cities are forecast as most likely to see price declines in 2026. While the specific list varies by analyst, common factors include markets that appreciated 40% plus during the pandemic, cities facing climate risk, fire, flood, extreme heat, areas with weakening job markets, regions where new construction is finally catching up to demand for buyers. This creates opportunities, but not necessarily in California. For sellers in these markets, timing matters more than it has in years. For us, sellers in these markets, timing matters more than it has in years. The inventory problem, the fundamental issue remains. California isn't building enough housing. Despite legislative efforts to boost construction, new supply has essentially flatlined over the last decade. One economist expressed skepticism about whether that will change. I'm skeptical that owners of single-family homes are going to give up the land to actually build enough housing to make a difference. It's good that all those laws change, but I feel like they might be muted in their impact because of all the other forces that are pointing towards single-family neighborhoods staying exactly. The lock-in effects, both from interest rates and property taxes, mean existing homeowners have strong incentives not to sell, even if redevelopment would create more housing. This keeps supply constrained and prices elevated. The bigger picture of fragmenting market, what we're witnessing is the end of the unified American housing market. The idea that housing moves together as one asset class no longer holds. Instead, we have coastal markets with supply constraints and high-earning populations, inland markets adjusting after pandemic booms, Sunbelt cities transitioning from affordable alternative to expensive in their own right climate. Vulnerable areas, where insurance and adaptation costs change. Affordability equation, a growing divide between homeowners locked into low rates and renters. First-time buyers facing today's prices. California encapsulates all of these trends at once, which is why its housing market looks so fractured. Who wins and who loses? Existing California homeowners who bought before 2020 are sitting on substantial equity. Their low interest rates and low property taxes create powerful incentives to stay put. This is good for their balance sheets, but reduces labor, mobility, and housing supply. Renters and aspiring first-time buyers face the worst of both worlds: high prices, high interest rates, and limited inventory. They're paying peak prices without the benefit of equity accumulated during the appreciation years. Families trying to move within California face steep costs that make even lateral moves financially painful. The lock-in effects mean many people are stuck in homes that no longer fit their needs. Too small for growing families, too large for empty nesters. Looking forward, the California housing market of 2026 will look different from city to city. Some coastal areas may continue appreciating. Some inland markets may decline. Climate costs will become a more visible factor in home values. Nationally, the divergence will likely accelerate. Will theories that adapt by building more housing, addressing climate risks, and maintaining economic dynamism will thrive. Those that don't will struggle. For individuals, the lesson is clear. There is no California housing market anymore. There are many California housing markets, each with its own dynamics, opportunities, and risks. California's housing market isn't moving together anymore because the forces affecting housing, interest rates, climate change, economic opportunity, quality of life, no longer impact all areas equally. The $900,000 median home price tells you less than which specific market you're looking at, what climate risks you're willing to accept, and whether your income aligns with the middle class definition in that area. For some Californians, 2026 will bring opportunities. For others, continued challenges. The key is understanding which California market you're actually in, because they're not the same market anymore. If you're navigating California's housing market or considering a move, understanding these local dynamics matters more than ever. The state average tells you almost nothing. The neighborhood level data tells you everything. Thanks for watching. If you found this analysis helpful, Please like and subscribe for more data-driven explorations of housing markets and economic trends. Share your own housing market experiences in the comments.